Hi and welcome to today's presentation where we have the pleasure to present NNIT. To help us through today's presentation, we are presented by the company by CEO Per Fors and CFO Carsten Ringius. This event will primarily cover the Q1 result update you sent out, but probably also a little bit about the finalization of the divestiture. So that's today's topics. As always, you can ask questions in the box down below. Do it through the presentation. We will take it in the end. Do ask both in English and Danish. If it's in Danish, I will try and translate to the best of my abilities. But Per, for now, I think I will hand the call over to you.
Thank you very much, and thank you also for the rest of you joining this call. I'm going to give a little bit of an update and set the context for the Q1 performance, but of course also elaborate on where we are in terms of strategy for the future new NNIT. If you please go to the next slide. The last quarter and the last 4 months has been very much characterized by us finalizing the transaction with divesting our infrastructure operation. It has been quite a long and complex process, and as you know, we signed a contract with Agilitas in June last year, where intention was to finalize the deal versus the ending of 22. But due to primarily governmental reasons and regulatory reasons, the deal was postponed into 23. But finally, we got it signed then at the 28th of April. Carsten is going to elaborate on the proceeds for the transaction a little bit later. But we are, of course, very happy to have come to the finish line. Also, on an overall level, I'm really happy to see that in parallel with this very, very complex and demanding transaction, we managed to move the business in according to our plans for 23. Of course, there's always a risk when you do this kind of thing that you become too internally focused and kind of forget your customers and your people. But I think we have fared fairly well in actually progressing our business in 23 according to the plan. But Carsten will allude more to and go into more to the numbers. Before doing that, I would like to share some slides with you all about the new NNIT that are now emerging without the infrastructure business, which will be actually a leading, highly specialized IT consultancy companies focused on life science internationally, but also here in Denmark to the public and enterprise sectors. If you please go to the next slide. We have set some quite ambitious targets for the future. We're going to come back with the long-term financial targets, but we have indeed been looking at us where we want to move as a company for the foreseeable future, which for us has been until 2026. And we are, of course, now without infrastructure, even more going to be a purely people company. Where, of course, our focus and our people to strengthen our position as a highly attractive employer is, of course, key. We're going to continue to focus on the international life sciences. And here it's not a revolution of our strategy. It's actually an evolution of the strategy already put in place through the work we have done during the last 3-4 years by really strengthening our position through organic growth, but also through M&As. So we today have a complete portfolio of solutions addressing the different value chain creation within the pharma companies. We're going to be a much more international company where we are now placed in Europe, in US, and in Asia, in all the really strong epicenters of the international life science. So we have the geographical coverage that we need to have, but of course we can broaden that into even more and a deeper, I would say, collaboration with many of our existing clients. We have a balanced portfolio also, thanks to that we have a quite strong position here in public sector Denmark, where we won a number of really significant deals in 22, which has created a big backlog for us in 23 and onward now with really strong wins, where of course the most notable one is we did Danish National Bank, but also some other governmental agencies here in Denmark, which provide a long-term recurring revenue upon which we are winning new deals continuously with add-on work for these clients. Then, of course, the new NNIT will be a company with less complexity and less overhead, because we can take off some of that overhead and complexity to be, firstly, even more agile versus our client, but also with a lower cost. If you please take the next slide. So, but the starting point is a good one. We wanted to be the best employer for the future, but also today our starting point is that we really have people that I used to say who are two-legged people. They both have a very, very strong competence in the business domain where we are active, be it international life sciences or in public sector Denmark. But also they complement that with the technological skills and deep technical understanding, because we are a technology company, but we want to base that technology knowledge and combine that with a strong business understanding. As said about where we want to be in the future, we are already today in really globally attractive markets. I just, together with Carsten, came back for a 1 week journey to Asia, where it's really energizing to see that we are present in some of the fastest growing pharma hubs in Asia, meaning in the, not the least in the Shanghai market, but also in Beijing, in Tianjin, and not the least also in Singapore. These are really strong markets with strong growth, and there's some heavy investment being done in these markets where we are taking advantage of this growth to grow our business. There is a high demand for our competences. These markets are the public sector and life sciences market, some fairly stable ground to stay on in a quite turmoil world that not the least you guys are very much aware of. Life science is really growing steadily, and there's a lot of investment being done both for the among the really big pharma companies, but there's also great investment into new companies, being it CDMOs, contract manufacturers, or startup with some exciting future in front of them where we are supporting them. Looking at our client base in terms of our logos, I would say we basically have the logos we need to grow our business. We are, with all humbleness, very small birds of many of these large companies, where there's a great potential for us to grow the present and broaden and deepen our portfolio of services that we deliver to the companies, and thereby create growth without having to hunt for so many new logos. Of course, we will not say new to new clients, and there are, of course, in parallel appearing great business opportunities for us out there. But I think basically from a strategy perspective, it's actually doing more business with our existing client base. Please move to the next slide. From a geographical perspective, if you put this in a little bit more in a context, I mean, we have a strong presence in Europe at many of the big pharma hubs in Europe, but not all. We are present in Germany and then southern Germany and around Frankfurt and in Switzerland, which are really, really big pharma hubs, as well as in Ireland. We are not that much present in England, around London and Cambridge area. That's something we are looking into. And then also France is a little bit of a white spot, even though we are doing some business from our Swiss location. So in Europe, we are fairly good position, but there are some steps we can take in the European landscape. In the US, we have most of our people actually based on the East Coast, around the New Jersey area, from which we also can cover the great potential which is in the Boston area. And we also have people situated on the West Coast to address the Bay Area. So in the US, it's a fairly small business, only less than 200 people, but there is really a great growth potential. And then I said, we discussed the Asian market before. And as a topping to that, we have the global delivery capabilities, which for us is based in Manila for global deliveries, and also in Prague in the Czech Republic to cover the nearshore demands, which to cover the European scenes. So fairly good geographical coverage. We have the right leaderships in place to be able to deliver to this new organization. We have also updated our organization to kind of being able to further accelerate our ambition. So we are now establishing a new organization, taking away some of the complexity of the past, which is actually 4 market-based regions, a regional structure with the 3 life sciences region, Europe, US, and Asia, but also one for Denmark, which encompasses the public sector, but primarily on top of that also a Microsoft business here in Denmark, which is growing strongly with a nice profitability. Next slide, please. So if we have our playing fields where we are acting, we are also then on top of this working a lot through partners. What we're doing for our clients, if you take life sciences first, is actually based on a lot of different partnerships. But a lot of our business is actually based on different partner solutions, where we have deep global partnership with many of the leading software solutions, which we help to work with our clients. We have a business first approach, not a technology first approach. And this is important. I mean, we base our kind of growth and our ability to support our client by listening to our clients, understanding their needs, thereafter supplying them with the right technologies. So in many of the different areas, we have multiple solutions to offer. So we always make sure that we have the client first approach. And then, as said, on top of the life sciences, we are also present here in Denmark in the Microsoft areas, and also through our separate brand Scales, which we operate as an independent group company. But there's a lot of collaboration on the client base with these capabilities, because we are the leading actor in Denmark, implementing Microsoft's ERP solutions, growing nicely and steadily with a really nice profit margin. With that, we can move to the next slide, and I will also then hand over to Carsten.
Thank you, Per. Just a quick overview on the first quarter. We produced significant growth, 16% organically, 11% from a low base though in Q1 22. We generated revenue of 430 million, generating an operating profit before special items of 20 million in Q1, resulting in an operating profit margin of 4.9%. We also had special items of 14 million. This is mainly related to earn-out payments to previously acquired companies. If we move into the next slide, we will go into life science. Life science also had a quite good first quarter with 14% growth, organically 7%, also driven by acquisitions of Prime for Services, which was part acquired in Q1 22, as well as positive currency impact. We see an increased profitability resulting in an operating profit margin of 10.3%. This is driven by a more balanced capacity and also, you can say, additional new contracts coming in. Going forward, we have a positive trajectory. We have seen several extensions and expansions of several long-term customer engagements, and we expect to be able to continue the acceleration of sales into our new international life science business, especially within R&D and manufacturing. If we move on to the CDS business, we also saw significant growth of 19%, of which 16% was organic. And this is, of course, driven by several major public sector wins in previous periods. We have seen a stabilization of earnings, but also improved capacity utilization. Also in this segment, we see a continuation of the positive traction and have a positive outlook for the coming quarters. We have been able to secure additional new significant contracts, which will impact our result positively in the coming years, but also in the following years. If we move on to the combined group financial, we saw a significant improvement compared to Q1 22. We saw a gross profit of 64 million with a gross profit margin of 15.5%. We saw operating profit of 20 million compared to minus 16 in Q1 22. And we saw a positive operating margin of 4.9% in Q1. On top of that, I can share that in relation to the IO divestment, we realized a purchase price of 1.35 billion after EBITDA adjustments, and that resulted in expected net cash proceeds of 1.288 billion, which is after net debt, NVC, and carve-out and advisor costs. This also includes a vendor loan note of 200 million. So that is all as expected. Going forward, Pierre will comment on our outlook on the next slide.
Yeah, on the last slide, just before going out for some questions, I mean, we are maintaining our revenue and earnings outlook for 23, and we have been very clear that as we was postponing the deal until to close under April, 23 is also going to be part of the transformation year, where we have guided for 10% revenue growth and an operating margin of 5%. And the reason for that is that we that is not our long-term ambitions. We have high ambition than that, but we are intending then to strive for double-digit margins, and we hope to see that and plan to see that coming versus the end of this year. But for the full year, we are maintaining our guidance, and then we will come back for the new guidance for 24. Maybe you, Carsten, can comment on special items. I know that sometimes it's of special interest.
Yes, I can say that in relation to the current guidance, we have an expectation of special items to the amount of 70 million. This is mainly related to earn-out payments to previous acquired companies of 56 million. And this is, of course, following the decision by the Danish Business Authority on the actual accounting treatment of this special items. On top of that, we see a small part related to restructuring costs for right-sizing the organization as part of this new strategy implementation. In relation to the actual IO divestment, on the announcement in June 22, we gave an estimate of expected carve-out cost of 200 million. As part of our annual report for 22, we reported a spend of 80 million, and the expectation is still that the combined special item cost of 200 million will be endured for the carve-out related cost, but the remaining cost related to the carve-out that we endured during 2023 is contributed to the discontinued business, hence not reflected in this guidance.
Okay, thank you, Carsten. That was actually what we had on our agenda before handing over to you guys and the Q&A.
Yeah, let's start by some questions. I think looking at this extraordinary cost, and you also take something down under the financial line or to the divested businesses. I guess there's still some cost overrun, carve-out cost, or what you might call it, that will hit you in 23. So how much extra cost is related to 23 and will not come in 24? And here maybe I'm thinking on what he will hit you on the EBIT line and not as extraordinary income and under the divested line.
Well, the plan is to you can say account for all the carve-out related costs in 23, which will be you can say part of the you can say booking of the final transaction and the gain statement that we will do here in 23. So this will actually include all the carve-out related costs that we have estimated that will be required for us to complete the carve-out, the technical carve-out. So that would all be part of the 23 discontinued business.
So nothing is hitting the EBIT line this year, you know, some cost overruns where you haven't been able to take the business down compared.
Well, what we will have is what we you can say label stranded cost, and this is cost that is you can say resting with NNIT after the divestment, which we'll take out through restructuring of the companies. You can say relooking at our facilities, what is really required, because you can say part of this divestment has been selling off a lean business, and by this we will have some additional you can say, for example, space or complexity remaining with NNIT that we can reduce. This will, according to our plan, take place during the remainder of 2023.
And can you give us an estimate on that, or is that not something you want to give publicly? You know, so we have an idea what will stay in 23 and what will not roll in to 24.
Definitely, I can say that as part of our restatement of our 22 numbers that we did some weeks back, what we announced or label as stranded cost was in 22 51 million. And this is really what you can say could be contributed to the divested part of the business. What we said in Q1 is stranded costs in the area of 14 million.
Okay, perfect. Then there's a question: will you be able to step up M&A now the sales process is fully over? You know, have you spent too much time on you might say on the divestiture process, or have you been able to continue some M&A? Do you have something lying in pipeline? I guess that's the question here.
I mean, firstly, I think we demonstrated a fairly nice growth the first quarter of 60%, even though we are humble and say that last year was not the best one. So the reference number was fairly low, but we are still content that we are able to grow the business. So for this year, the focus will be actually for the organic growth, but we are very comfortable that we have a really good M&A process in the company, and we have been able to integrate the company and execute M&A transaction in the past year, and we intend to accelerate that in the coming year. So for 24, we are really gearing up, and we will also start doing some actual work already this year. But we are just seeing that we deem it unlikely that we will present any completed M&A transaction in this year, but we will definitely start to accelerate that process for 24.
And then there's a question here: how are you going to use the revenue from the sale of the infrastructure business? Whether you can allude a little bit that to Carsten, and maybe explain us the 1.28 million and the vendor note on 200 million. Is that you got around 1.08 million in cash, and then 200 million will come in cash on the hand in the future, and maybe a little bit on how you are going to spend the money coming in?
Well, you can say initially we have repaid our revolving credit facility, so we have used the proceeds to actually strengthen our balance sheet by repaying the credit facility that we have had in the past. This has been, you can say, part of the plan all along. That once that you divest such a large part of your business, you will have to refinance you can say your current credit. So we have used it for that, and we have now an interim credit facility in place that will allow us for you can say some time to put a permanent financing in place that can also accommodate for our future plans on the M&A side. As to your question on the net proceed, what is included in the 1.288 is, you can say, a series of elements. We had the NBC element, we had the net debt element, we had some costs related to the carve out, and we have some tax elements. Not all of these elements are occurring at the same point in time, so this is sort of the net effect over a period, if you understand what I mean.
Yeah.
And you can say the vendor loan note is to be repaid latest within 6 years. So that is sort of the horizon on the 200 million on the vendor loan.
And then I know you didn't show a P&L here. There's a question here. Can you comment on your balance sheet after the investment, i.e. the net cash position? What is the net cash position after this divestiture?
I cannot comment on that, but I can say it has been it's been of course a very positive development. We have been able to repay our debt, but I'm not going to give an exact cash position at this point as per this date.
Perfect. We will have to estimate that ourselves. Then there's what kind of EBIT margin should we expect in the continuing business, excluding stranded cost? I think you alluded on around 40 million that is stranded cost. Was that correct? And then we should take your guidance of around 5% EBIT margin. Is that the way to maybe calculate it?
Well, what we said initially when the closing was planned to be end of 22 was that we saw, you can say, the need for we had to go through a transition period in Q1 and Q2. Now with the you can say the delayed closing by end of April. We still consider Q2 and Q3 for a transitional period where we have to take out costs, where we also have a little bit additional cost that we will have to address. This means that we still retain our full year guidance of a 5% operating margin, of course, but with an improving operating margin towards Q4. And as Per then delivered to, our long-term ambition is, of course, heading fast into 2-digit numbers to you can say reflect that we are a very specialized and international global successful consultancy company. Hence we should have a better operating profit margin performance than what we realize currently. But we'll come back on a specific guidance on that once that we get into giving guidance on 24.
Yeah, perfect. And I have to ask, your type of business, comparing that with, with a specialized IT consultancy business, do you see anything in your type of business that shouldn't make the margins that they are hitting? You are very specialized. You are in growth segments. So kind of to give a feel until we hear from you on the longer term margins, is there anything that we should not expect your longer term margin to be comparable to other IT consultancies, or could it even be better with your highly specialized focus?
I think one comment on that. It depends on what you mean on a comparable peers, because there are many different consultancies companies out there. But to give you some reflection of our ambition and our starting point, we are not an overall IT house selling everything to everyone. We have decided to focus on just 2 industries primarily, right? Where we have a strong client position with a well-developed portfolio and highly specialized people that understand both the client business and how technology can help them. Not just the technology perspective. And if you look around in the world on our peers, companies who have a deeper business understanding and are able to combine that with IT usually are able to provide higher margins than a company selling just generic IT services to a broader number of sectors. But then how that will translate into our long-term ambitions, we will come back with. We guided for this year, which is a transitional year, and then we've said that the first station on the way is thereafter to be able to provide, good double-digit numbers, and then we will come back to when we are guiding for 24 what that means. But our ambitions are high, and we are very comfortable about where we are as a starting point.
And if I should take you to a point, you say you expect to make high value creation for your customers, that should also turn into some kind of a good margin. Perfect.
Yep, correct.
And then there's a question here. What is the expected market growth in your market segment? I guess you now have 2 very large ones, the pharma business and and the public sector. So do you have any feelings on what are the market growth expectations for those markets? And do you expect to take market share in any of them?
Yeah. No, I mean, we've been looking at that as part of a kind of when we have been looking at the strategy and how we can accelerate the strategy. And not to surprise to me, to be honest, but to surprise of some people, if you look at the international life sciences market, where we are kind of acting in with our services, and also the market which in public sector Denmark, it is actually fairly similar, a growth of 8-9%. But honestly, for us, that's just some information. It's not that very interesting, to be honest, because we are so small in these two markets. So our ability to win market share is so big. I think we have a 2% market share, and that's of course very rough numbers on the global scale within life sciences consultancy. So you can, of course, as an analog to that, see that there's enormous growth potential to gain market share. But if you look at the overall market, they're growing 8 to 9%, both markets.
So that's still stable. Okay. Then there's a question here: how many is employed today? How many is working in Denmark and abroad? And can you get the people you need for your expansions in the right hubs and such? What you talked about, I also guess. Is it possible to get the people you need for further expansion?
Yeah, and one is an initial question before going into the competency war of talent is, I mean, as a consulting company, there's going to be an extremely tight correlation between our ability to grow our business and the number of people we are. So when we grow our revenue, we're also going to need to grow our people. There are some repeatability of services. There are some AMS services in the bottom which we would like to expand. But still, it's going to be a very close connection that we really need to grow our the people base. And I would say it is actually a very competitive market. It is slightly easier in Asia, where it's such a huge population. So there is, I would say, it's slightly easier to find the people. And also in the US, we are so small, so I think it is more doable. While in Europe, I think the demand is greater than the supply. I mean, we could grow even faster if we would have more people. And we are going to put even more effort at strengthening our employer brand to make sure that we are even more attractive and more publicly known in some of these markets. So it's a tough market, but I think we know how to maneuver in that market.
And how is the split abroad and in Denmark, your employer base? Do you have that figure on the top of your head around?
Yeah, no, we are around 1,700 people, and I think if you take away the support function, the over 50% of the people are outside Denmark.
Okay, perfect. And then there's a question to you, Carsten. You alluded to 16% growth, 10% in first quarter, 10% guidance. Is there something special here, or is the explanation, as you said, that you had a very easy comparable base, or is there something, because I think you alluded to that you kind of look pretty good in executing and had a good pipeline to execute on. So a little bit of question, why 16% this quarter, 10% full year?
Well, as we mentioned, it was from a low base on the growth side, and from a margin point of view, we expect some additional costs in Q2 and Q3. So this is why we still maintain the full year guidance of 5%. On the growth side of the 10%, yes, we are realizing 16%, but 11% organically, and it was from a low base. So this is the reason for us maintaining still the 10% on a full year basis.
And then that's a question. How are your exposure split between biotech and pharma in the life science division? You know, I think you alluded to, you both have the startup, the big pharma, and the middle pharma, and we can discuss it, but the exposure maybe to biotech in a world where they can't get financing. So to get a feel of how are you actually exposed in your life science?
I would say in a revenue base, without can be able to read any detailed number. I mean, the primary client base is more traditional pharma. but who are actually doing a lot of investments. And then we are actually active when we were in Asia on visiting some CDMOs, so some contract manufacturers, also in biomedicine, not just chemical medicine, if you use that word. So we are really active in the part of pharma which is growing, but I don't think we are exposed specifically to clients who are in needs of a big capital infusion in order to grow. In the US market, we are at some of the more startup pharma base, but in terms of revenue, that's a smaller part of it.
That's a smaller part. And then lastly, we hear a lot of customers to kind of your solutions and so on are talking about optimization of their IT budget. What is nice to have, what is needed to have. So those discussions, how are you feeling that, and maybe a little bit of comments on your pipeline going forward?
No, if we start with like international life science, I think the pipeline looks really good, and it's driven. I mean, it's still, when you look at external analysis of the pharma life sciences company, I would say they are a little bit lower on the maturity curve regarding how do they really exploit the opportunities of technology to make their go-to-market processes shorter, which, as you know, is of extreme importance in the pharma company to shorten that market. That process as much as possible, so you haven't utilized too much of the patent period just in getting the drugs to the market. And of course there are many other factors than technology, but they really cannot afford not to use technology, automation, AI to make that as short as possible. And here we are a very important partner to make that happen. So I would say that we see a good market out there. So looking at our pipeline for the future, if you look for 23 and also looking now into 24, we are fairly confident with the market position. And looking in the public space here in Denmark, which is an interesting market as well, it's also a fairly good pipeline. There's some really big tenders coming up versus the fourth quarter this year, and we are confident to continue on the winning path that we started some 18 months ago in the public sector Denmark. So overall, we are feeling fairly confident, but of course, there's always work to do, right, to win new deals.
Perfect. I think we got through the question. Thank you to you, Per and Carsten, for taking us through, and may everybody have a nice day.
Thank you. Bye-bye.